Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Welcome to Stocktake. My name is Gaurav Sodhi. This is a founders free edition because I'm here, by the way, with Nick Cummings. Hey, Nick.
Hey, guys.
And also regular analyst Graham Witcomb. Hey, Graham.
Hey, Gaurav. You nearly said regular host.
I almost said that because
after one hosting experience.
All right, we got to talk about one thing that's very important: the absence of John Addis from this, and we all know the reason why. So John claims that he has something else on today, but Nick, with the World Cup on, have you noticed that John's been quietly absent from a lot of things lately? We had to change the time of our research meeting because England was playing.
Oh, the replies to emails.
Yep, have been
days, not hours.
no message replies while suspicious games are on. Yeah. She claims he's busy, but we know what's really going on. When does this damn tournament end? It's very disruptive.
Another 2 weeks, I think. It's been great. It's been great. I disagree with everything you were saying. This is an amazing time to be alive as a soccer fan or a football fan.
No, to be fair, I think, look, I've had some bad luck with it. Every time I turn it on, because my wife's a massive fan and we're trying to get the kids watching it. But every time I turn it on, all I see is 3 people passing the ball to each other like they're in some suburban park. And I'm like, what is the big deal about this game? And then I get shown the highlights and it looks amazing. And I feel as though I always walk in and watch the boring suburban ball passing moment and I miss the grand stuff. There's a point to this because that's exactly what it feels like with investing at the moment. Like we're sitting there holding stocks that are going nowhere, even though, we know that these things are working and we know that there's value on offer, but they're just passing the ball to each other like they're at the park. And in the meantime, there's people making stellar returns on these crazy ideas. SpaceX. What a stock to own. I really want
a bicycle right there.
I want to meet a SpaceX investor. I know too many sensible people, so I don't know who owns it, but I want to meet one and just say, what are you doing? Like, tell me the case for it. What's in your head? Besides, I just want to buy something that goes up. All right. Let's carry on, shall we? Speaking of stuff that only goes up, we had a massive shock because one of the stocks, during this whole SaaS apocalypse, we've had a few stocks that we've kind of identified as companies of interest and that we've been watching and potentially waiting for an opportunity. Objective Corp, the ASX-listed document management software business, was one of those companies. Nick, this company fell 40% in a day. And ordinarily, you'd think when a business has a big fall, if 2 months ago I had said to you, would you buy Objective at $6? I think all of us would have been, yes, absolutely, I'd buy that company at $6. It got, I think, below $6 on the day. I don't think anyone was interested in buying it. Talk us through what happened, and then let's talk about what's changed.
Well, I think the big thing here is we don't actually know what happened in terms of we know parts of it. Like part of the details are they lost their biggest customer, which was the Department of Defense, and essentially their annual recurring revenue will be flat this year. So I think it was about a 10 to 15% revenue hit. So it was a big hit for them.
Yeah.
But the more I read into it, it was like that they had reached commercial.
We should say, by the way, that the reason the stock fell was because they lost their biggest customer.
Yes, the Department of Defense.
Which they've had for 25 years. I believe it was their first significant customer in the business.
Yeah, it's crazy how it came to pass. And that's what I meant at the start when I said we don't really know. I mean, I read somewhere that they had reached commercial terms. The discussions had been going on for 3 months. And then on the 30th of June, the Department of Defense pulled the plug. Wow. But the announcement was so vague, we don't actually know what's happened. We don't know if the Department of Defense has doing this in-house or a competitor is going to be used? Was there a budget cut and they just thought that Objective was a nice-to-have product that they could get rid of? In my opinion, if that is the case, that would be a worst-case scenario because it suggests that Objective's software isn't as mission-critical as we probably thought. But it's a real doozy. Who knows? It could be a negotiating tactic. It's really hard to work out, and it wasn't a surprise to see the stock fall so much because it was hard to say, okay, well, this is why they did it, and to rationalize it. It was this sort of like, oh, it happened, and we got a phone call last night, and that was it. And it was like, oh, wow.
I have a bit of the theory that it is a negotiating tactic because they weren't like the Department of Defense didn't completely cut Objective from them. They said that they're going to continue to have wild scale use of it. They're just cutting this upgrade and support program. So it makes me think that they do have kind of that customer captivity that they've always been preaching. Objective has always been preaching because the Department of Defense can't just walk away from this thing that's embedded with 100,000 users, 140,000 users or so. But it kind of shows that they still have some commercial tactics that they can use, which is delay upgrades. They can resist support terms or things like that and kind of hurt Objective in short-term ways to boost their negotiating position. You wouldn't have thought that having the Department of Defense wouldn't have a strong negotiating position, but being their biggest customer. But maybe they were getting tired of the cost increases and weren't happy with Objective's next round of upgrades or something like that and wanted to push back a bit harder this time. So it wouldn't surprise me if they actually do continue with the company and they don't switch to a competitor and anything like that. And this is just a way to kind of, I don't know, maybe there's some grumpy guy at the top that wants to force their hand a little. And I think by the stock's collapse, he's probably done that, or she.
I got to say, Graham, this is you sound very rational and intellectually well prepared for this. I guess you know the company better than anyone on the team, actually having covered it for a while. But for me, I was flabbergasted by this. This floored me when I saw it. I was actually on the holiday. I was overseas and I saw it. And I think I had a sort of 5 minutes of just speechless shock. It overturns everything I thought I knew about Objective Corp. We've always been told that this is mission critical software that has a very sticky customer base, that the cost of the software is very small in relation to the larger software stack of its customers. So customers the company's always said, and analysts have always said that the customers aren't all that price sensitive, and you can see that in the history of the business. And they've also said that there's no real domestic competitor with the security clearances, and that this is an arse covering software. This is a software that someone buys so they don't lose their job. These are all very powerful stationary forces to keep the software in place, and none of them were enough to keep the oldest, largest customer. I think, in my view, this overturns everything I thought I knew, not just about Objective, but about SaaS companies. There's a larger question here, and Graham, I'm going to ask this of you. Does this change the way you think about SaaS generally, or is this quite specific to Objective?
My gut says that this is specific to Objective, but it probably shows that, I mean, the shock that you had is similar to what I think most people would have seen when you get a 25-year customer this large defecting from what's supposed to be a captive customer environment. But I think that shows that people may overestimate the captivity of a lot of these customers for Objective, but maybe even for broader SaaS businesses. But that's probably just a misunderstanding from the outside rather than it actually changing anything at the company level. Maybe a lot of these large customers are just waking up to the fact that they can push back, they can cause issues, and eventually the SaaS business will be able to respond to them a bit more. Maybe it's just a rebalancing of who has the most leverage in that kind of trade.
Nick, what do you reckon?
Yeah, I think it might be specific to objective, but I think it does highlight a bigger point that the companies that are listed on the ASX in the software space, I don't think are quite as good businesses as they're made out to be. And I think we've been quite careful over the years with the software companies we recommend. And at the moment, I think we've only got one software company on our buy list, and it's not on the ASX. That's despite the biggest sell-off in software in, I think, history. And that probably says something about these businesses. I remember looking at the accounting treatments that they or how they expense their and amortize their R&D, and frankly, for a lot of companies, it's pretty shabby stuff. It's pretty shocking. And so I don't think these companies are as high quality as some people think they are, and they maybe overestimate the moats. I mean, I might just name some of the software companies.
Oh, please do.
Like these are the ones on the ASX, and I don't want to cherry pick. I'll try and get a large variation of them. You've got Nuix, Life360, Xero, Iris, Fineos, Bravura, Curia, ReadyTech, Serco, SiteMinder, WiseTech, and then there's some really good ones like TechOne and ProMedicus, but you have to pay up for them. Look, a lot of these businesses they're okay businesses rather than being good to great businesses. And I think a lot of Australian investors, because our universe is so small, have sort of made up in their minds that these are better businesses than they actually are. These are not globally competitive software companies. These aren't the Microsofts of the world. And I think that the risk is that next level down that you see on the ASX is potentially at risk of more disruption than maybe the market is, even pricing in after these price falls.
Yeah, no, I agree with that list completely. The three stocks I had on my software watch list were TechOne, ProMedicus, and Objective. But Objective is now, it's very hard to know what to do now, because although I think it's now on sort of 18 times earnings, which is a reasonable price for a business like this. But we don't know what the DoD is thinking. Like, do they have an internal solution? Do they have an IA derived solution? Is there a competitor? It wouldn't be the first time where a business has said we have no competitors, and all of a sudden we have competitors. WiseTech famously has been saying for years we have no competitor. It's only us. But inside their employment contracts, they have all these strict clauses about how key staff members can't go to competitors, and so they've clearly got competitors.
They've spent the last decade actually buying competitors or competitive solutions in different countries as well, which is kind of funny. And they just lost their largest customer or they're about to lose their largest customer to an in-house solution. It'll take them a number of years to actually get all the freight volumes off, but it will eventually happen. And so there has been a few holes poked in a few of these companies recently, and it's sort of come at the same time when a lot of investors are questioning how disruptive AI will be to software overall.
I also want to reiterate the point about accounting. I think you've been very strong and early about this, Nick, but a lot of these companies have dubious accounting treatments of many items. My personal pet peeve is ARR, annual recurring revenue. I think this is an entirely made-up metric. I don't know why you would want to value a business based on contracted revenue. I'm still old-fashioned. I like to look at cash flow and earnings, and I think they're the measures we want to use to value these businesses. And an unaudited, made up. Every company has its own way of how they value this ARR. Some companies, if they have a 1-year contract, that's ARR. Some businesses, if they have a 3-year contract, that's ARR. Like there's no standard way to measure this, and I don't know how so many investors have been convinced that you can use ARR as a legitimate valuation tool. And the other thing that has really bugged me, and I'm sure I've ranted about this in meetings, is made up stuff like the Rule of 40.
Oh, I was going to say this. Yes.
The number of investors who are just scrambling, looking for these Rule of 40s. You've just fallen for the marketing spiel.
Why not 30? Why not 50?
Yeah, so I completely agree. A lot of the accounting treatment has been dubious. Apart from those three software stocks I mentioned, I'm not convinced. I particularly think WiseTech and Xero are the most overrated stocks on the ASX potentially. And I would particularly point to Xero and say that stock's down from $200 down to $70, and I still think it's double the price it ought to be. And the management has had so many problems. I think it's wild that they're trying to change the compensation for the CEO after they've accomplished none of their goals just because the price of the stock has changed. If in any other industry, if this was a miner trying to do that, they'd be howls. They'd be out the door. But because it's a software SaaS business, and the share price has been higher for a long time, we get a different treatment. Graham, I think I want to get your thought on this as well, actually, because I think narrative is driven really by share price. And a lot of investors just look at historical share price performance. They're like, wow, this is a great business because the share price has gone up for a long time. And that's not true anymore. What do you think about that idea? How important is the share price in creating these narratives?
Oh, I think it's absolutely important. I think people just have a general cognitive bias towards, first of all, anchoring on that share price as being the most important metric out there. So when it goes down, you think, oh, well, I'll just wait a little while longer until it goes back to that share price that I bought it at or something, even though the stock doesn't know what price you bought it at.
So he doesn't know what time you bought it at.
That too. Those stocks are not very cluey. But also in terms of the biases that go with share prices, you have this confirmation bias effect where as the share price is going up, it reinforces whatever narrative got it going in the first place. That's the whole kind of bubble psychology, is that the longer the bubble continues, the more reinforcement you get that your internal stories are correct, and then it all just hits a breaking point at some moment, and then the emperor's clothes are kind of shown to be gone, and the whole thing falls apart.
Yeah. Now, I think anyone looking at software stocks, I mean, these valuations are so important. And I personally don't think there's any software business where you should be paying more than sort of 25 times earnings. I would say Pro Medicus might be an exception just because that the economics, the gross margin is astonishing. And maybe Tech One, it's a single line of code software business. It potentially is a little bit different as well. Again, very high gross margins, and all the product changes kind of shared across all customers. So there are specific reasons. There are some exceptions out there, but as a whole, I think this really does blow a hole in the whole SaaS myth. And I think we've had a bit of a software bubble, and the prices we're seeing now are entirely appropriate and sometimes even too high. Nick, are there any software businesses on the ASX left that you've got your eye on?
No, I think you've named the two. Pro Medicus is, I think, the standout. And it's a standout for a number of reasons, but maybe let's focus on one thing we have been chatting about, which is the accounting. The accounting of Pro Medicus is fantastic. They don't expense, I think, any R&D. They expense all their R&D rather than amortize that and then put that through their P&L over a number of years, like WiseTech and even Tech One do to an extent. The margins are 70+% operating margins. I mean, that's higher than Visa's.
Yeah,
it's a real outlier, I think, and I agree. There's not too many software businesses that I want to own long term. I think there's a lot of people at the moment trying to pick up or investing in these software businesses, hoping maybe they've been beaten down so they'll get acquired, or they can make a quick double or something like that. But for long-term investments, there's hardly any that look really attractive to me.
Go on, Graham. What do you got?
Oh, I don't know if any of the... I mean, Pro Medicus is definitely up there. If I had to pick a software stock that was the most interesting, we got pretty close to upgrading it. Was it earlier this year or late last year? And recommended people start to accumulate a small position, but we just didn't quite get to the trigger price that we were after. So yeah, missed out on some of the gains since then.
I just think it's hard. I'm not too hard. I don't think anyone on the team owns Pro Medicus, and I understand why. It's very difficult to buy a business on that kind of valuation. A lot of it's just style. I'm okay with missing out on Pro Medicus because it's really not my style to buy that price business. I think you got to be very authentic about what style works for you, and not be chasing stuff that doesn't is not compatible with the way you think or the way you invest.
Yeah, I completely agree. You've got to buy stuff that you can sleep at night with all of the volatility, because otherwise you're going to make silly decisions. As soon as a bad announcement about Pro Medicus comes out, you're going to panic. That you really need to. That's right. To find stocks that are sustainable to own for you, based on your own.
Yeah, just imagine if you had bought Pro Medicus because it's been going up, and then all of a sudden, it went from 300 to 100, right? Something like that. There's no. I wonder how many investors actually held through that downfall, and it's had a very quick rebound. These prices move around a lot, but you have to have real conviction in what you're buying, and that includes the price you've paid for it.
Yeah, and it also means conviction in the company beyond the share price, because it would have been equally hard for people to see it go from $50 to $300 without selling it on the way up. Because if you don't really understand the value that it's providing, or you've just got a hot tip from someone, you're going to sell it at the first bit of profit and not actually hold on for the long-term gains.
Yeah. No, I agree. All right, looks like we've solved software, boys. Let's let's take a quick break, and we'll come back to our next problem.
Picking investments, rebalancing, and keeping on top of markets can feel like a lot. InvestSmart makes it simpler with professionally managed ETF portfolios. Open and fund a new InvestSmart portfolio in July and receive a $100 bonus contribution. Visit investsmart.com.au to learn more. Remember, past performance isn't a promise of future success. Terms and conditions apply.
Now, Nick, we're going to do something we rarely do, which we never do. We're going to promote something that we've done. We're joking, of course, because we shamelessly promote things all the time, and we're going to do it yet again. But you sat down and did an Amazon deep dive. Now, for non-members should be aware that we do deep dive podcasts for members only. These are sort of 1 hour long, in-depth look at a business that we find particularly fascinating. And previous examples have included MinRes, New Hope. What else have you done? CSL. And Nick, what's the other one you did?
I know, this is my first.
This is your first. How have you got away with only doing one when we've done all these other ones? They are very, very tight. Of all the content we produce, these are the most time-consuming and prep-heavy. So, look, if you're not a member, we'll give you a little taste of what we spoke about, because I do think Amazon was very interesting. Nick's been covering that business since he joined us, and has really illuminated that company for me. I probably wasn't that interested in Amazon until I met you, Nick, and it is now way up there for me as a business that I would love to own. Just give us a minute, maybe 90 seconds of what you spoke about in that deep dive, just to fulfill the brief here of shamelessly plugging our content.
Yeah, so John and I spent about an hour discussing Amazon, and I guess the whole conversation was shaped around Amazon's flywheel, or its virtuous cycle, which is essentially that all these little improvements in the customer experience has led to more traffic coming to Amazon. As more traffic comes, that entices more sellers to come to the marketplace. As more sellers come, that increases product selection, and that in turn increases the customer experience. And that's how they sort of got the flywheel going. And then as their revenue started to grow, they could spread their fixed costs across more goods. And so they were able to lower the cost per unit and then pass on those savings to customers through lower prices, which again, improves the customer experience and increases traffic. So that's how we sort of went through the podcast. And we started with its history, why Bezos chose books to begin with as their first category, discussed the other e-commerce segments and how they've all been designed to really quicken that flywheel. And then we also discussed AWS, which is their Amazon Web Services or their compute business, and sort of looked at Amazon's massive capex spending and how that could earn adequate returns, and spoke a bit about AI as well. And I think that last point is probably the big debate over the stock at the moment, and probably for those that haven't looked at Amazon or haven't listened to that deep dive yet, it's probably the biggest takeaway of just how we approach that.
And they're just I love that there are so many ways to win with Amazon. There are so many little hidden parts of that business. I mean, the AWS business itself, no one was looking at that sort of 10 years ago and thinking this is going to be huge. It was an internal product that was just launched. And then they've got this chip business. They've got like a SpaceX competitor. Like there's so many ways to win. Graham, do you own Amazon? Is that a stock on your watch list?
No, I mean, it's a fascinating company, and I love reading Nick's commentary on another commentary that I read out there. But no, I've never owned it, particularly during its, maybe beyond 6 years ago when there were no real operating profits. There was nothing much to go on. It was all still just hope. But it's become an absolutely incredible business, as anyone would recognize, seeing it over the years grow into what it is. So yeah, I don't own it. Maybe wish I did own it, but I mean, it's just never fit me in the same way that we were talking about before.
I remember a friend of mine worked at a US hedge fund actually, and he was saying to me, you got it. This is, mind you, this is about 15 years ago. He was saying to me, you got to check out Amazon. And Amazon was pretty hyped. It had a massive valuation. It made no profit at that stage. I was looking at the accounting. I was like, what? This guy's very smart. What the heck is he talking about? And so then he explained to me, he's like, just look at this. He said that Amazon has built AWS, which is a capital intensive, data heavy business that's required tens of billions, maybe hundreds of billions of dollars of capital. He said they have built that and they've done it without any external capital. So that tells you that the core retail business is actually generating piles of cash flow, and you're not seeing it as profit because they're reinvesting in this other stuff. So there's a very profitable cash flow machine here. And of course, I thought that's a great point. I was really enthused, and I did nothing about buying it because I didn't have an international account and missed out on the greatest opportunity to buy Amazon, I think. Go on, Nick.
Yeah, no, it's a great point that this is how their working capital model in that e-commerce business, which is essentially we pay for goods online before you receive them. So there's that real working capital benefit, how that's been able to fund these ventures. We sort of spoke a little bit about that, and there's a few big takeaways. And maybe if I tease them out, we discussed how I think Amazon isn't really a retailer or a tech business; it's actually something else. And that what Amazon is really selling is trust. And we sort of spoke about why that's the case. Pretty much, if you go through almost every Amazon product, there's a very high degree of trust required between Amazon and their end customer. And then I think you mentioned there before their chip efforts, but also just broader, the concept of control that runs through Amazon. And there's one specific reason I think that allows them to develop these in-house efforts better than almost anyone. But I guess I'll save that for people that want to listen to the podcast.
All right, let's leave it there. Look, if you're a member and you haven't listened to the deep dive, jump on the website and sit down for an hour and listen to that. I do think it's really worthwhile, and it teases out very important points of one of the most astonishing businesses of our generation. And for everyone else who's not a member, what are you doing? Go and sign up and listen to that alone. And Nick, I think you're covering Amazon ongoing as well, so you get further updates along the way. Look, I think we better hold it there, boys. I'm sure Nick wants to go and watch some soccer game or something, so let's call it.
Games are over today, Gaurav.
Oh, there you go. No more grown men kicking balls in a park. Graham, good of you to join us on such an awkward hour.
Thanks, Gaurav.
And Nick, as always, lovely speaking with you.
Thanks, Gaurav.
For everyone else, thanks for listening.